Okay, this is a video about real estate. Now, I don't want to fake it. I don't want to start lying to you and start speaking over you or anything like that. And I don't want to be rude. I am not a real estate expert. Other real estate experts might be politicians or something, but I'm not. But I thought I would make a real estate thing. Now I renamed this 750 partners. I wonder why it's 750. Uh, this is a real estate case that somebody gave me, a really nice man, and he suggested, will you help with the model? Now, in this case, you're supposed to take a portfolio with 3 million square feet. So what we did is we changed this around, changed the names around a little bit. And there's a rental rate and there's an escalation. I think that's escalation is very high. We're going to make a sensitivity analysis, and I'm going to try to make a spider diagram as part of this case. And then there's this base stop. So what I had to do is go to Google, find from Miss Google what the base stop means. It means when the tenant will the tenant will pay 12 USD per square foot, but above that you got to pay. Okay, and then there's some capex, but you don't have to pay that, and there's a term. We're going to emphasize the importance, like in any financial model, of a term. Then we have financing with a loan to value. It doesn't say how much the value is, okay, and we don't have any amortization of the debt. Now, that's bizarre. I would think you would sometimes have amortization of the debt. And then there's this thing called release pricing that we were really struggling with. And I'm not sure if this is one. So when you sell a part of these locations up here, you have to pay down the debt. For me, this is like an oil project. When the reserves on an oil project go down, you've got to pay off the debt. Now, is this 130% of the allocated loan to the property, or is it 130% of the property value itself? I don't know. So I'm going to make a little switch. When we read this up, it seems to be 130% of the loan value itself, okay? Meaning that the equity holders in that case can't, in fact, they got to pay more of the loan off when they sell the asset, and you've got to wait longer to get your cash flow back. Okay, so we'll try both different ways. And then we have this IRR, this little IRR thing where we have an operator, and I'm going to put the operator here. People, when they write these case studies, I wish they'd be more careful. To operator. Okay. So that's what we have. And of course, I'll put this case study on there. And then there's this thing called cap rate. The cap rate, if we do a cap rate, if we do a regular old stupid old Gordon's model, it's C times 1 plus G divided by K minus G. Now what they do is essentially you put the C is the cash flow, and the cap rate is the cap rate. I'm sure I'm sorry, I'm going through this basic thing for the people who are real estate experts. Cap rate is the cash flow divided by the value. And if we use our theory and assume this value never goes down, which is ridiculous, we have 1 plus G divided by K minus G. And it's really basically, if we take this 1 plus G away, and we can say it's just K minus G. So if the if the cap rate is something like 7% and you think the growth rate's going to be 3%, the implied cost of capital is pretty high. It's something like 10%. Okay, please build an annual model. It says an annual model. Okay, but I'm going to do a monthly model and an annual model reflecting the post-promote leveraged IRR, post-operator really, leverage an equity multiple to this company called 750 USD in taxes, uh, 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 and put a sensitivity table based on the going in and the exit cap rate. Okay, so let's get this set up now. When my friend who did this, he put these rental rates in and then kind of escalated them, and he put some of the assumptions in, and I'm going to have a little disagreement. And then we had our, he put a little X there. That's kind of an interesting thing to do, but we won't do it. And then here, there was nothing that has kind of the operations. This data table was kind of nice, but I'd like this data table to be on a separate page. And I'd like to, as I said, and we used matched index instead of lookup, and then there's kind of a little bit of a long formula, a couple of things here, and we had some offset functions, which are very fancy, but maybe you want to use an offset function if you're doing a summing things across, okay? So maybe occasionally I'll use an offset function here. Then we had a debt schedule, and then this is kind of good. He put the waterfall in. I would keep this waterfall on the same page, obviously, and put the assumptions. So the one thing I didn't talk about here was they want to move ahead with a strategy of liquidating the entire portfolio in 7 years, starting in year 3 and likely 4, mid-year. Okay, and they were hoping to get a compression. That means if the cap rate goes down, the value goes up. Okay. Um, if we want to figure the whatever the cap rate from the value from the cap rate, that's the C times the cash flow times the cap rate. Okay, so let's uh, let's start with our model. All right, and we could use some of this, but here, I'm not insulting anybody at all in this video. I'm going to be so nice. Okay, let's start by, of course, instead of just having one little column here, let's have 3 columns so we can use our generic macros, and let's put an input sheet first. Okay, and then let's maybe Alt-EM and copy that. We don't have to do that. That's kind of stupid. Alt-EM. Okay, I'm not doing it nearly as fast all the Excel. Okay, and what eventually we'll have is I think really for this one we can put our whole model in one sheet. And then let's put our sensitivity table, and let's be, if hopefully I'll have enough time to put a spider diagram, because I just was working on it. And then the only reason I did this is so I have to don't excuse me, I can't get words out again. When you get old, that happens, I suppose. Let's start with our timing inputs. Okay, and the big timing input is when our model will start. Now, what I decided to do when I just reread this, let's put a date here, um, even though Shift Control 3, even though we don't really, we could change that. We don't really need it. And let's put the months in model. Okay, this and getting the timing right is absolutely uh, essential in any model. That's what I want to emphasize. And And we could make our model annual or quarterly, monthly. I'm going to make it monthly, and then we can change it. We should be able to change this timing, and let's see if we can get everything right, because I've been struggling with this. And what I'm coming to the conclusion about is very often, if there's any chance you're going to have to make the model monthly, make it monthly, because it's going to be a whole lot more painful to make it, take a semi-annual or a quarterly model and make it monthly later. And then we can put the term, and we can put that in years. And we put this, if we look at our assumptions again, it says term 25 years, even though we want to be out of this in 7 years. Okay, so really they've got some of the timing timing up front. I mean, the timing kind of inconsistent. So we'll put 25 years. And then we'll put end of model. Okay, now I think I'm just going to make absolutely sure something is happening here. Okay, so this is going to be another date. And let's put equal e-date and go to our start date and put this times 12, okay, and shift control 3. So that's first thing. Let's get some of the dates right. And then let's put sale dates, and we can put, how about let's put year sold, and maybe we want to have it. They weren't really clear about this. We want to sell this project at different dates, and the whole thing will really come down to what kind of cap rate we assume, and perhaps along with some inflation, because this inflation rate was kind of ridiculous. So we're going to make a sensitivity analysis on the cap rate and really the inflation rate. I suppose we could make a assumption about the operating expense as well. But okay, so right now they said starting in year 3 and likely in year 4. Let's see. I can't remember what Friend did here, and he had some sales here, sale proceeds. This was a monthly model, so we had 1, 2, 3, okay. And it looks like there was a negative sale, but we don't really want that. So year sold 1, let's put that in. So that was ridiculous. Okay, here's what I'm doing. I'm going to pause the video a lot. I made a mistake just now. When you would make these sale dates, put them all in one row. Don't do this, please. I hope I'm not going to get in trouble, but don't do this kind of stuff where you put the stuff at the top, because then you can't select the whole line, and you can't use the lookup really. No, you can, but it's going to be a pain. And even if you use this match index, which is really obsolete now, because the what is it, the X lookup or the lookup, I think it's the X lookup, correct? Okay, so let's put that in. So we kind of start to get our timing in, and then I also put this portfolio. If you want, we can put, no, don't put it here, because that's going to be for years. Yes, we can. I think we can put this in, because we won't have that. So, well, we better put 16.6. I meant to do that. So we put a little check. Be creative with your checks. Don't be bureaucratic about any modeling at all. For me, the whole business of modeling is not being bureaucratic, not following some silly kind of rule, although I like a philosophy about modeling. That's very different. If we use fast, flexible, accurate, structured, transparent as a philosophy, it's good. But as a bureaucracy and a blah, blah, blah rule, it's horrible. Okay, so after we have that, then let's put some operating inputs. And what I always would suggest is let's start with the, the, the basics. So when I saw this case, I thought, that's perfect. So they have 300 locations and 3 million square feet. So let's put that in. We might even not really use that. And I don't know what these are these apartments or something? Okay, and then, okay, and three, come on, 1, 2, 3. I'm going to put this in because I'm very basic. I don't want to start putting it in millions or anything else like that. Okay, and then we can put in some price. How about let's put some macroeconomic. Now I'm doing this I'm doing this on purpose because uh, inflation in lease, inflation in up X. Now, what they assumed, this is such shit, really. Uh, Sorry about saying it like that, but they assume 3.5% and 3%. So they're assuming perhaps if we have general inflation, uh, um, they're assuming a real increase of 0.5, and you better have a justification for that. And it's just like any kind of growth rate. If that occurs for a long time, Shift Control P, if that occurs for a long time, that's gonna be an enormous variable. Okay, and let's also put in here, I suppose let's put our cap rate. So let's put our base cap rate, or let's call this our entry cap rate. Now this could be almost like a leverage buyout model or something like that. And let's say that's I'm going to use 6%, even though my friend used 10%. It's 6%. Remember, if the growth rate is 2, that says there's a cost of capital applied to the operations, not to the everything else. Okay, and then let's put this crazy thing, which is the cap rate compression, which is an absurd variable just to be itself. Let's put 0.5%. Now that's enormous assumption. That says the value is going to go up and up and up. It's like we're assuming a multiple can go up and up and up. I would really start with 0, and I would say maybe should be negative. The reason it might be negative is your project's older and there'll be newer stuff coming online. But whatever, I'm too conservative, obviously, especially for real estate. I don't even put pictures here or anything else. And then and I can't imagine a real estate analysis without beautiful pictures. And then let's put price and revenues, and let's put the price, and I'm going to stop here. Okay, let's stop. Pause. Okay, so I entered the price and the operating cost, and then we have this base stock business, which again the tenant pays. So the tenant pays that, and anything above that gets paid by us. Okay, and then we have some debt financing. Now, when we put the debt financing in, and this is a nice order. I think part of this is good. They had the operations first, the rent and expense, and then the financing. And we have a 6.5% interest rate annual, a and we're going to make this, if it's monthly, we will make sure and not overstate the interest rate. So I guess all we have to do if it's annual is we can just this time divide it by 12 because we're not having any amortization, and there's an origination fee, and uh, uh, and that's that. And I think what we better do is put an extra a month in our model. So I think we better have the transaction date. Let's have that uh, 1 year or one earlier. So I've got an American computer, so that means I put it like this, I think, right? Okay. And then but for these ones, uh, let's put uh, uh, we'll call it operation start. Okay, and we'll put another date there and make this uh, uh, and and then this one we better refer all this stuff to here, and I this is kind of a pain to do this. Sorry about that. Okay, and now I'm going to just put in that financing. Okay, now the complicated part of the financing is this stuff, this release pricing that we looked up, and maybe this is a percentage of the sales price, or maybe it's the sales price times the loan to value. It would make, for me, a lot more sense to have the sales price times the loan to value, but maybe it's the sales price. So when we sell an asset, we have to reduce the loan by 130% of the sales price, and we might have to actually get equity into the company. We'll have negative equity when we do this. Okay, that for me makes less sense than making it a percentage of the sales price times the loan to value. Okay, but I just don't know. I told you I'm not a real estate expert. I'm trying to go through this with you and learn from you and give me some comments and tell me what the correct thing. And then they said maybe there's a full cash sweep, which means you take the sales proceeds and you just have a cash sweep. So that's just 100% of the loan. That's that's an easier one to understand. So when you have something like this and when you don't know it, make a flag, and I'm going to make it false, true. So that means this true says we're going to apply the release pricing. False is the sweep. And very often when you make one of these, use a checkbox. I when I have an input, it's so often that I use this. So we'll put, and this one you have to go blind sometimes. Oh, not this time. Uh, okay, uh, and then of course I say of course, which is really a horrible habit I have. But I'm not a debater. Okay, and then we click on that and we can make it true or false, and we'll do the same thing for this. Okay. And I guess we can copy this. When you would right click on this one, it says 37. So let's make this 40, which means we're not exactly sure how this is going to work. And we'll put this in here. Oh no. We'll put this in here and we'll call this uh, release total release, put a dash total sale. Okay, so we're going to have to pay the whole thing. And if we don't know it, we can put equal not true. Okay, so we can apply either assumption, and then for the car sweep, it said 100%. So we can apply all of these. And then we're just about finished. And the last section we have here is this interesting section on the and this is another reason I looked at this. I said, "Oh my God, this is not so easy," because we have a little table for the 750 partners or the operator, and maybe for this table it might be good to okay, let's put the equity allocation, and the first thing I hope you see is that it's not so bad. We have the different uh, um, different timing. Then we start with our operations. Then we put our operating cash flow, our debt cash flow, and at the end of the waterfall we have our equity cash flow. And let's put our operator, and then 750. Okay. Why do I use 750? Let's put the uh, equity percent. Okay, so this one maybe I'll see this. This is not a perfect way to do this. Well, they put in 10%. The other ones, and then let's have maybe we should do this initial hurdle rate. So if the hurdle rate, and let's put that as a percent, and if the initial hurdle rate is below uh, uh, operator, it's over 20%. If it's below 20%, let's put it like this. Excuse me, I'm rambling, but okay. So let's put a 0%, and we go up to 12%, and then when we're above 12%, when we go up to and when we go up to 18%, very high IRR, okay, then we can do the same thing. We can put who gets what, okay. So if it's the operator gets 0% here, and the partnership, the investor gets 100%. But if we're uh, if we're at over 12%, then we're 20%, and then we're 30%. So you can see, and for me, a good example for this would be, what was this, 12%? No, this was 20%, and this was 30%. So what we can do, and then this is equal 1 minus that. Okay, that's going to be a tricky thing to model. How do we model exactly when this flip occurs and how it occurs? And this happens more and more, I think, in project finance. We give the operator a strong incentive to get a really high IRR. I don't know, by cutting the operating expenses, making sure the utilization is working, and all of that. Okay, and let's press Control Alt C. This is very not exciting. I don't even want a top color. I'll use some conditional formatting, and we'll put it in B. Okay, now I guess there's one thing that could be a little exciting about this, and that is if you looked at my friend, he had kind of this thing. I think that was kind of a cool thing. And if you would want to put that into the generic macros, what you would do is you go to this default values, and this is a title option, and let's copy it, and let's put a flex. Come on. Okay, so that's that. And then we can copy this one up to this one. Okay, I left the kind of main one here. We press implement initialize, and we go to the I think Control Alt C, and we color the sheet. Now, what I'm working on right now is a method to find all the circular references that we'll have to add. That'll be my next thing to do. So that's our starting point. Okay, and now let's make our model. All right, and to make our model, the biggest deal for me is to leave a bunch of blanks here. And let's start right at the top with our timing. And let's, up here, put a period, even though we might not need it. But, you know, if we have month by month for 25 years, that's annual. What's 25 times 10? It's 250. What's this times 12? We could have 300 uh, things. Now, that's going to be kind of totally ridiculous because we're going to sell it by period 7, but let's leave it. And let's put the date. No, and the next thing is let's put months in period. Okay, and let's recognize we're going to have this. Now, I'm sorry, I'm repeating myself a whole lot. If you've watched any of the other videos, I'm repeating myself way too much. But we want to leave extra space here, and we want to grab the inputs, and of course we want to color them. So right now we're going to make it a monthly model. Now the little thing said we might make it an annual model, but for right now I'm just going to press the F4 key, Shift Control R. Now, of course, the other people, God, the way that you can go fast to the right, back, Control, blah 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 blah. Oh, I don't do that. Sorry. And then let's put the date. Now this is much easier, but at least our model is going to be completely flexible. And let's make the very first date the transaction date. We could have, I suppose it would have been better to do it like this, perhaps, and maybe put a E date here, comma, minus this one, perhaps, Shift Control 3. We don't really have to do that. And then we put equal E date. And we put this comma 1. Now I just realized something. If we want to be really careful about our transaction date, this might be not so good. But we're going to put our transaction date here, and let's make that a flag. Now that's kind of obvious, and perhaps you don't really need to do that. But all of our sources and uses of funds will be in that thing. And whoops, and of course everybody is so fast with the way they click on the F4 and do all of that stuff. And then once we have our transaction date, then let's put our well, let's wait with the sale dates, I think. Okay, and of course just haven't thought the whole thing through, so we should put our operating period. Now, I think actually, and how about I'll just put equal not true, okay? And how about we'll multiply this one by 1, and then we'll multiply this one by 1. Okay, and how about up here, we'll make this our sum column, and this is our driver 1 column, and this is our units column, and this is our driver 2 column. Okay? This is my bureaucracy, I suppose. Okay? Control-Alt-C. Now we have this option to put our little flexible colors here. We can mark the links from the sheet here. And since we'll kind of put this up here, perhaps we should put a number 6 as our format. Okay. All right. There we go. Okay. So that timing is so essential. If you don't have a consistent timeline, I just don't know what to do. And I know a lot of people don't make a consistent timeline. So now let's just put I think before we start, really, let's put our sale dates, sale, property sales. Okay, and what we need to do is figure out when we're selling. So what we'd like to do is put this when we have this. I'd like to take this date, and I'd like to take this date and match it against this. We could use the match function, but I'd like here, and we could kind of use the lookup function, but the lookup function will keep it. We need the match index, but we don't need the match index anymore. I'm going to try something really, really exciting. And we'll put sale period or something, and I'm going to use the lookup X, and I don't know why I never made that. Oh shoot, I couldn't even spell it right. Okay, so let's practice this lookup X. Is that the way it is? Or X lookup? Sorry about that. Sorry about that. You'll see I've just started using it. Some nice man told me about this. So we put X lookup, and we go up to this lookup value, and you notice this one, it has kind of an extra thing. And if we match it against these dates, and then we put the return array, and if it's not found, let's put a 0. And let's put another 0 for an exact match. And then what else do we have? And then we search from first to last. That means from small to large. I'm not sure we even needed that last one. And then if you go forward, here it is. And in fact, let's put Shift Control D. If I didn't, I can't do that damn thing. I keep on getting this wrong in the videos because Shift Control D is. So we have 1, 2, 3, 4. We have our sales dates. Okay, now once we have that sale period, that's the first time I really needed X lookup. It's so exciting. What an exciting day. And then let's put percentage of the portfolio sold. So before we do this, why don't we put the locations in square feet? Okay, so let's put location. Okay, and let's put location before sales. Okay, so let's put number, and let's get that driver from our input sheet, and then we'll get the square feet. And I'm sure you use square meters, but And I'm so bad with real estate. God. In another video, I told you I have my father's house and I'm trying to sell the damn thing. Oh, God. My father, I loved him very much, but selling his house is shit. Okay, and I guess if we're really technical, we should multiply this by the operating period. Okay, and let's do the same thing for the locations. Okay, and okay, and I'm gonna do my formatting in a minute here. So once we have our sales period, then we can have our percent sold. Okay, and for that we can just use the I think we can just use the lookup, right? We use this, we go up here and use this lookup, tell me if I'm wrong, and then we get our amount, and then we put our percent sales of this in. And the only thing we have to fix with the lookup is we better get a 0 in here, so we don't have all these. Why did it? This is what I was worried about. I told you I couldn't do this. I'm taking this one out. That's bad. And then so we can go up here, and then let's do our check here. This is much better, isn't it? We better make sure we're actually selling our whole portfolio. Okay, and then of course the next thing we can do is we can put square feet sold. Okay, and that's just going to be the amount times this. Okay, and finally we can put our square feet balance, and so what we should do is maybe I'm going to do something that's not really that great, but I think this is again my favorite saying from my friend who died a long time ago is foolish consistency is the hobgoblin of a petty mind, and we'll put this number minus this, okay, and I'll fix the stupid formatting later, okay, and fine, and that balance better go to 0. We could even put a little check that balance goes to 0, and hopefully it does, and I have an inconsistent formatting that I don't like, and we put a little extra percentage in here, but we're basically there. So once we have the property sales, then let's put the revenues and expenses. Okay, but before we do, we want to make absolutely sure that when we get our inflation in. So let's put our revenue or sales price inflation rate that I complained about a lot. Okay, percent P dot A. No, we're going to put P dot P. And then we're going to put this 3% in, or this 3.5%. And sometimes what I do is try to add a little, I'm not going to insert a column or do something to explain that this 3.5 is not the same as the others. And this is where we really use our thing. Now, we have to be really careful when we're doing this. We want to be able to use this and make sure it works in an annual model as well as a monthly model. Now, we might not actually put the inflation rate in here, but we take 1 plus the inflation rate and we raise it to the 1, not 1, this divided by 12 and put minus 1, and that will force it so if we change all of the months in the model to be 12, we'll get exactly the 3.5, and it'll compound up to the right number otherwise. And then we can decide how these inflate later. We can put that the inflation period occurs only in January, okay, and that might yield a little bit of a difference between our annual model and our monthly model, but let's keep going. Okay, and then we'll put a sales price index. Okay, and I used to go around about this, and now I'm gonna, yeah, I'm gonna put a 1 here. And if the auditors are gonna start moaning about you about this, then tell them to go to hell. Really. Getting all freaked out about an auditor who's not gonna allow you to put a 1 here is really, it's so irritating. I can't even take it. I'm sorry. I know some of my really good friends have these really good ways to kind of manage that. Okay, but I'm just I'm working on a project now, and it's the mall is getting auditors, and my partner's like, oh no, it's getting audited. Who cares? Okay, costs. Inflation. And my boss, the guy, my boss, he's whatever, said, "Oh, leave some errors in there on purpose so the auditors can find it." God, what is that about? Okay, and I'm just going to leave this, and we'll do this exactly the same thing again. That's 1 plus the annual rate raised to the 1 up here divided by 12 minus 1. We'll see if this whole thing can easily convert to an annual. Uh, okay, and then we'll put our index. So this is kind of like the same thing. You start with the 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 uh, whatever I was talking about, the macroeconomic kind of stuff. Okay, although I didn't put our sales price in yet. But notice there's no financing yet. No financing at all yet. Okay. I'm already at 43 minutes. Oh my God. Okay, and then we'll put our price and our revenues. How's this? And let's put our cost. Oh, we've got to do the cost is going to be a little trickier. Okay, the price is going to be our I can't imagine anybody watching this, really. Okay, so our price is just going to be this. And why don't we, okay, let's be lazy a little bit. I think that we can be lazy here. Let's multiply that by our inflation index. That's an enormous kind of assumption. Now, I realize what I should have done is perhaps inflate this only in January. I was just thinking about this. But you know what? I don't want to do that right now. And let's assume now when we sell this thing, uh, right now we're selling it at the start of the period. Okay, so is that right? So what we should do is take this amount. Be careful with the start and end of the period minus the amount we sold. Okay, because the square feet balance, that's the balance at the end of the period. And if we multiply it by a cap rate, no, we can sell it at the end of the period. I'm sorry about that. Let's just take by our balance. Okay, so that's our revenues. I'm making it really, really wide now. Okay, we don't need those last decimals. I'm going to stop the video in a minute, and then we're finished. Okay. Now, the next thing we have is let's work on this base stop, okay? And this means that the tenant pays the total expenses, and the rest are paid by us. So I think the way to do it, and I'm just speaking out loud, we'll put total, why don't we put total operating costs? And the only thing that's really going to have an effect here is inflation, okay? And we'll start with that. And then we'll put the amount, come on, it's not that hard. And then we'll put paid, paid by, which is this same thing. We take this amount, which was our starting point, and then that's how much they pay. So this is going to be paid by investor, whatever. I'm sure there's a better way to say that. And this should be USD, this should be USD, and this should be USD. Okay? And remember, my friend's model, and this is really, I saw this and I'm being so mean, but you know, this formula is, I'm sure, correct. I'm sure it's correct, but it's a perfect illustration. It's a perfect illustration of kind of trying to get these things FAST, transparent and flexible. You want to be able to read these. You don't want to be able to whatever. And this one, I should have multiplied this one, by the way, by the, we want to make sure and have a transaction period here. Okay, so our total operating cost is going to be our number multiplied by this, multiplied by the square feet, multiplied maybe by our operating flag. Okay, so that's this. And then our tenant, it's almost the same thing. We press the F4. This time we don't multiply it by the inflation. We do multiply it by the square feet, and we do multiply it by this. Okay, and then we'll have the difference being paid by the investor, and then we can use that in our operating cash flow. Okay, and I'm going to pause this for a minute. I need to take a breath. So let's move on to I formatted things. Let's move on to the operating income. Not a big deal. And then let's after we have the operating income, we're going to move to the sales proceeds. Oh God, I gotta stop. Okay, and for that we need annual forward operating income. So I started asking my friend, oh, maybe it's not. Are you sure it's the forward and not the historic? No, it's the forward. He said, well, what about this last year? And we'll have a problem because we don't have any operating income. And so let's also put annual historic. And the way he did it, which is good, okay, is using a sum offset. And I've noticed, I hate it. I really do hate it. Where's a sum offset? Here's a sum offset. Oh my gosh, here's a sum offset. So there's some sum offsets. And let's not be intimidated by this, okay? Like I am. No, I'm not, but I've just found that I don't know, I made too many errors. So we take our um, difference between the operating income and the operating costs, and then if we want to look forward for 12 months, now we got to be a little bit careful. If you put some, let's look backwards for 12 months. sum first, and then you put offset. Okay, and then you go up to the thing, and then you keep it on the same row in the same column. Not a big deal so far. And then you have one row. That's easy, and the columns are a little bit tricky. But if I put, actually, if I want to go to the next month, the next period, start with the next period, I put one column forward, one row, and then we take 12 divided by this one. So if it's annual, it'll just be 1 divided by 1. And then, oh, shoot. Come on. Oh, I'm so stupid thing with my, come on. Okay, I'm just going to make one bigger. Okay, and if we wanted to really make sure that works, we put 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 561. There it is. And we can do that for each of the periods. Okay, and I can't get the formatting right. The stupid, God darn it. Okay, and then if I wanted to go backwards, that works okay. If I wanted to go backwards, it's going to be a little bit trickier because we can't go backwards. For 12, we're going to get a reference. So we have to only do this once we hit period 12. So we have to put an if statement, and make sure our counter is greater than 12. And I don't know if I should have put 12 in, but I'll leave it. Because maybe if it's how about 12 divided by this thing, this, we can do it like that. Then offset sum, and then offset, and then we go up to our same thing, put comma 0 for the row. We can this time keep it on the same column because we'll be going backwards from this year, and then we'll put a height of 1, and then we'll put a minus, and we'll put 12 divided by the months in the period. Okay, and then we get a false, and then by the time we hit year 12, then we're going backwards 12. So this is 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and that should be 561, and there's our 561. Okay, so that's how you use this sum offset, and I'm sad to say people are so proud of themselves for using this damn thing, but it is occasionally necessary. And then how about we'll put the last the last sale period, because if we go to our last sale period now, I just realized something. If we really, I'm sorry, I think my friend got it a little wrong. We can multiply it by a inflation rate, but we're going to have to use the historic period. I'm sorry, because otherwise the the operating income will be lower because we sold some of our assets, and I'm not going to do this. I'm going to put index, growth index for historic, and I didn't get that out. I'm sorry. And then we'll just this will just be our whenever we'll put our 3.5% in here. It's really 3.5% minus the thing, so I didn't get it exactly right, but we can put multiplied by 1 plus we could get really fancy and put the difference. And this should not be this one. It should be just simply this. So whenever we have our uh, operating income, we're going to increase it by a little bit. That's consistent with the Gordon's method. And we'll put income for cap rate. Okay, and let's just multiply it by I was wrong. We'll take our historic number multiplied by the cap rate, and then we'll maybe it's if we're really precise, this should be divided by 2 because we don't get over the course of the year, it doesn't inflate to the end of the year for the whole period, so we could get even a little fancier. And I did it again wrong. What an idiot. We'll take this divided by 2. Okay, good. And now let's put our cap rate in. But before we put our cap rate in, perhaps we should put this craziness that we have where they said there could be a cap rate compression, meaning that the valuation is going to go up. Okay, and where did we put this cap rate compression in? Up here. I put it up here. So this is per year. So we're going to, why don't we do the same sort of thing we did with inflation rate? Cap rate compression. Okay, so let's put it as a percent and let's get our number. And let's do this business where we put 1 plus the cap rate, and then we raise this to the 1, this divided by 12 power. I hope you can see that this is absolutely crucial to, it's not absolutely crucial, but isn't it nice to have these things at the top all the time? Just the stuff you're going to really, really need. And then let's put cap rate, and we'll actually let's put cap rate accumulated cap rate compression. Ridiculous kind of assumption, but maybe real estate people make these kind of things. Maybe others do too. And we don't need anything here. And we'll start with our 1, and we'll multiply it by 1 plus this. And let's start after the only during the operating period. Okay. Now, when we do this annually, we're going to have to kind of make the very first months in the period 1. We'll have 1 month for our sources and uses, and then go forward. Okay, but we'll do that later. So this goes, and this was an idiot thing I did here too. Okay, so we're just going to. This was so bad. We'll just add this. Okay, and then we'll eventually. This is so ridiculous. By even putting I'm going to put 0.0 5%. Okay, so maybe we get a little bit of compression, and then let's put our cap rate. Okay, and we'll use our starting cap rate first, which is this 6%, I'm assuming, and let's do this one, and then we'll put this minus our accumulated cap rate compression. So if we have something like this, That's what we can do, and then we'll put value of the property. Okay, and remember, we take to get our value. I think I said multiply by before, but we'll take this divided by our cap rate. Okay, so we don't have anything yet, and then we'll get this, and I'm going to stop again and put this, and then we'll put entry value, and let's use we can use our little flag. We can say when we can take this transaction period times the did I just do that wrong? Divided by the cap rate. Good. This one divided by the cap rate multiplied by our transaction period. Okay, that's that one. All right, and then we can now put our cash flow from sales of property. Okay, let's put this in USD. And let's take our flag. Finally, we have, or no, we don't have a flag. We have the square feet that we sell. Just a minute. I'm gonna pause for a minute again. Okay, so here's what I'm going to do. I'm going to finish this up and through the last part, which is this equity allocation. Equity allocation we'll put into a second video because it's a little bit tricky. Okay, and what I have done is I've included titles. So let's see where we're going. So the first thing we're going to do is compute how much cash flow we receive from property sales, and then we need to get the total pre-operating cash flow, which is from both our net operating income and our cash flow sales, and then we'll get the unlevered IRR. That's our first step. Now we're going to start putting the debt in, and we're going to put the total entry project value in here. We'll put it right here. That's our total entry value, and we better include the fees of 1%. And to avoid a circular reference, we're going to have to use a tiny little bit of algebra. I'm going to do that. Okay, and then we'll put 65% of the total as our loan, and the remainder is the equity. And then we'll further distribute the equity into our two contributing partners. That's, for me, setting up this sources and uses of funds is absolutely essential in anything other than a corporate model. Once we have that, then we'll start our loan balance. Now, the hardest thing about the loan balance is the repayment. We'll put in our how much this release pricing business is, and then we'll put in our loan to value, and we're going to put two methods. One where we just take 130% of our total proceeds, when we take 130 times 65%, and then we'll get our total loan payment for release pricing, but we also might have a loan repayment from the cash sweep. So that's just 100% of the sale proceeds. And then we'll put another little switch here and get our total repayment, whether it's from the sweep or what's this business called again, this release pricing. Finally, we'll put our opening balance. We had no repayments. These are just repayments from the asset sales. And then we'll have a repayment in our final year, just in case, because we used one of these methods, we paid too little or too much. We better put a minimum in there as well. We'll put in our interest rate. I lowered the interest rate, but we'll put in that on a periodic basis, get our interest costs. And then finally, we'll compute our cash flow waterfall, which is our operating income, add the proceeds from sale, less all the interest, less the repayment of debt, and we'll put our equity contribution in and get our net equity cash flow. Okay, and that'll give us our equity IRR, and we can then immediately see, is this equity IRR, if this is less than the 12%, we could stop, but of course we won't. We'll have to test something. If it's above 18%, we're going to split this equity cash flow into our two partners. And that's really the trickiest part of this business. So if you've been watching this video to wait for that, and you're going to see it in a second video, you'll probably give me a big thumbs down and call me an asshole and everything else. Okay, so now let's put our sales of property in. By the way, what I did here is I put a sum column in column H. And what's going on here? Where's my generic macros? Oh, what's this shit? What is this stupid thing? What happened here? And then it automatically found column H. It took me ages to do. And then we put in the rest of this crap. And now we'll have a sum column. I strongly recommend that if you use a sum column, you don't use my fancy little boxes because then when you switch it around later, it might be a little bit of a pain. Okay, so there's our sections of our model, and that's structuring the model, and being careful in structuring the model is a really big deal. Okay, so let's get on with it and take our percent that we sold, and we have to make sure, and I think we're okay, that we take the value of our property in the year we sold it. Okay, and we better make sure, I hope, well, because the cap rate went down and the inflation rate went up, and this seems like a bad result. The sum already told us there's something wrong here because we're selling all of it, and we should be selling it at a higher cap rate than we started. I've got to pause for just a minute to figure out what's going on here. Now I can't see the error here. I can't see any error here. Here was our last sale, and our last sale just occurred before the income. We can look at our value of our property. Now that is going down because we have less square foot, and I believe we can look at all of our values, and we're selling the first time we sold our property was in this one, and the value was a lot higher, but then the value is going down. So I think this is okay, actually. We'll see, because then we got to take this number that we get from the asset sales plus our operating income. That's the total we have. Okay. Um, uh, let's get the sum of that. So that's a lot. Well, more. It's somewhat more than our entry, not dramatically more. And let's put our XIRR and get all of our uh, uh, income and our expenses. Okay. When I was struggling, I was wrong. I was wrong. When we take this percent of the amount sold, we have to make the percent sold as a percent of the previous balance. Otherwise, we're selling 50%, but 50% of a lower amount or 25% of a lower amount. And the other thing I think we should do is if we even put a pretty small change in the cap rate compression. Okay, where's our cap rate? We put this in, even if it's very small. Okay, then our cap rate is going from 6, and we'll go down to just a minute. I was just wrong about that. I had an error. We shouldn't have. I double counted the accumulation, so we're okay with this. So right now, with a point, let's put 0.5%, not point, yeah, 0.5% cap rate compression. Let's put 1% cap rate compression. And when I put this cap rate compression, I also put, just to make absolutely sure we don't get a crazy answer, I put a minimum. And when you put a minimum, you kind of do the opposite with the minimum and the maximum. So the cap rate has to, if the cap rate starts falling below 5, it has to stay here at 5%. We can't let it go completely crazy. So that's something to add. And then once we do all of this, we have our unlevered IRR, which is a key thing to have in there. And, you know, I sometimes, I think it's, we'll call it ungeared IRR. And I think it's important to put it in a couple of places because if we get some crazy number, we should really stop. All we're doing here is we're buying an asset at one multiple, selling it at another multiple. So now let's get started with our financing. So let's take our entry multiple and multiply that by the operating period, by the financing period, and we can do all this kind of stuff for this. So we hold one for 1 period. Now, if we make the fees 1.5% of the debt, I've got to go through an algebra. Hold on. So I'm sorry for my little algebra here, but if we take the fee time is equal to the cost, the fee itself is part of the cost gets multiplied by 65%, and that determines the fee. We have a circular reference because this determines this, which is multiplied by this, which is multiplied by that. So we can just do a little bit of algebra and compute the fee as the cost. Let's see if we can do it. It's the cost times the where am I? The cost times the fee percent times the loan to value, because it's on the loan to value, and then we divide it by 1 minus this times that, and we get a number. Okay, and let's see if it works. We'll take this plus that is the total cost. We can even copy those all the way. No, we can't, because we gotta eventually move these or delete those. So I'll delete that for a minute, and then we'll take our loan is our total cost times that. Why is that giving us a funny number? And then we can just check if this really worked. This divided this, yes, this divided by that. Usually I get it wrong. So you know what I'm going to do? I'm going to copy these and put these little hints over here by our debt financing inputs. Okay, so if in case we have to remind ourselves and delete them from here. So we have our total uses, and we have our sources. And I have to, and then we'll take this minus that to get the total equity. And then what we'll do is we'll further take this equity and we'll split this up. And if we didn't do this, which of course I could have, if we didn't do this here, if we didn't do this here, and we didn't get these numbers, everything would be a really big pain. Now, let's get the value of our property, which we happen to have up here in the when we computed the cap rate. Now, I'm not sure exactly. Oops. I'm not sure exactly how this release pricing works, and so if somebody is nice enough, which he won't be probably, to tell me, no, you're so full of crap, here what you should do. So every time we could compute our how much the value of our property is relative to this lease pricing. And then we could take that and actually, we should put the value of the property sold. That was kind of silly. Okay, so let's go up and get that number. Okay, and then if we're gonna, the question is, once we have that number, I hope I did it again, and once we have this number, how much of that we're gonna multiply it by this 130%. And then my question, I think we should multiply it, but I'm probably wrong, by the loan to value to get how much loan should be reduced when we sell the value. So we're going to take 130% of our value and then apply it to the loan to value. Now, I don't know what's exactly the right one, so I put an if statement. If this is false, if this is true, then we're just going to apply the whole amount. Otherwise, we're going to apply the other one. So that's what you do with those sorts of things. And we didn't need this one. Sorry about that. Or we could use a cash sweep percent. So the cash sweep payment would be just our cash sweep multiplied by how much of the property we sold. So if it's a cash sweep, we're just going to use all of the value for this. And of course, I don't need this, and I should have put this as USD, and this should have been USD. Okay, and then our repayment is we put an if it's true, and we have to remember what's true. The sweep is true, and the other one, the release payment is false. We do that one. Shit. Okay, and we get all of our stuff. Now, it might be that there's a little debt left over when we do all this stuff. So what I think you should do is just take and say, put a little flag here that says, take this number and put an equal sign. And you remember what we did, and it was really kind of the key to get this whole thing done, is we put a sale period up here, okay? And if we want, we could have put up here for the sum, we could have count if. That's kind of a silly thing to do, actually. And we take this and put comma true, and we get one sale. So then when we get our balance, our debt balance, let's put our opening balance equals to the prior year closing balance, and then get the draws of the debt from the sources and uses of funds statement, and then we get our big asset sales thing. That's the big number. This is the amount we're looking for. This was as usual. The complicated part of a model is the repayment of the debt. And then I'm going to take I'm going to take the opening balance. We will never have any additions, but minus the amount we already paid, and multiply that by this number to make sure I don't have, make sure I pay everything in the last year. And what happens if I have negative cash flow? That could happen too. So we'll just have to look at that. And we should also put another thing in. These repayments better be the minimum of the amount we're trying to do or the opening balance. So you can see that we have very simple formulas throughout. And let's kind of look, let's do this. Let's put the for this final sale year, let's put a balance in last year. Okay. And this is really just a test. Okay, and let's just take this true and multiply it by this one. And then we copy that across and we get the sum of it all. Okay. Huh. That's maybe good news, but maybe something funny happened. And it seems as though we applied the minimum, I think, here. Okay, we were trying to pay down a different amount. Okay, so all of these things that we do could affect the repayment. And so, yeah, you know what I'm going to do? I'm going to. This is the one that I really don't know exactly how it works. So we can put this little thing up here. When you copy it up here, sometimes you might have to go to the format control, by the way, and go to colors and lines and fill it with something like this, I think. All right. And then for the interest rate, don't forget to make it periodic. So we put the 4.5% interest rate, and let's divide it by 12 and multiply it by how many periods we have in the year. Shift Control P, and then we take our interest and use the opening balance, which is very correct because we don't have anything in that first transaction year. And then we have everything done. And then let's take our operating cash flow from our operating income. And after we have the operating income, let's get the proceeds we have from the sale here. We already kind of put it together, and we take this plus that, we'll get the pre-financing cash flow. Maybe we'll make a underline, and then we can take away the interest expense, and we better also take away the repayment of the debt, which includes the repayment just in case from our final year. And then let's put a minus on how much equity so let's get the overall equity, contribution before we split it further. And our net cash flow will be our pre-financing cash flow minus pre-financing minus the interest minus the repayment plus the minus of the equity, and hopefully, whoops, and since we have an IRR up of 14%, okay, we can get our XIRR and take all of our cash flow and compare all of our cash flow to our periods. And we get 24%, which makes sense, and that's an enormous rate of return. And that's going to depend a whole lot on that whole compression of the cap rate. So if let's say we did this other method doesn't make that much of a difference, and we can put a cash sweep in. But what will really make a big difference is our cap rate compression. Okay, that was this crazy issue that we have, both inflation and everything else in that. All right, so that's our first part of our video, and I'm going to stop it now.